This video is sponsored by the programs on building your wealth, linked down below. Check out the Stocks and Psychology of Money group with options trading, technical analysis, long-run investing analysis, fundamentals. Also check out the real estate investing course, property management, do-it-yourself rental renovations, and making YouTube videos or selling real estate. All those programs linked down below with a 41% off coupon code. Hey everyone, me Kevin here. In this video, I'm going to talk about the sad reality that inflation might end up coming in October as a September reading worse than we expect. In this video, I'm going to break down exactly why and the catalyst for this. We're going to talk about cars, we're going to talk about oil, wages, important pieces that go into this, and importantly as well, we're going to talk about what I'm doing about it. Let's get started right after I mention that if you want to get life insurance in as little as 5 minutes, just go to metkevin.com/life and Apple Pay or Android Pay for it, and that way, if this ever happens, level 99 Slayer, you get slayed. At least you got life insurance for your friends, family, or whoever you make your beneficiary. Check it out by going to metkevin.com/life. Apple Pay or Android Pay for it. All right, let's get started. So, first things first. The Bloomberg Commodity Index just hit a record high. Part of this has to do with the fact that we currently spend $1 per gallon more on gasoline than we did a year ago. We're also spending 2.5 times as much money as we used to on natural gas. Food is up 33% worldwide. Commodities are through the roof. Cotton has been skyrocketing recently. Aluminum skyrocketed over 40% recently. And commodities across the board are not only inflating in their price, but they are staying high longer than expected. For example, take lumber. With lumber, we were expecting lumber prices to go up as we had supply shortages. We saw this coming. Then we saw lumber prices go down, and we thought to ourselves, see, inflation is transitory. Everything's going back down. It's all good. But folks, there are weird things happening. Lumber prices skyrocketed to about $17.50. Lumber futures fell to under 500 to about 480. But what's weird is, folks, now they're coming up again, going back to 642. We are inflecting back up again. Certainly not as violently as we saw in April and May, but we're seeing an inflection point up again. But lumber's not even the one that we care about mostly right now, because home building starts have started to slow down, maybe taking a little bit of pressure off of lumber. It's all of the commodities together, which have been skyrocketing, staying at higher levels for longer than expected, and they're not showing signs of relenting. Take, for example, the Manheim Used Vehicle Index, which is outside of the Commodities Index, which is showing the same type of pattern. We saw this insane run-up in used vehicle prices at the beginning of the year, potentially as a result of all of the stimulus money that has flown into the economy, despite the fact that factories shut down during a recession, expecting that people would be saving money and buying less cars, when exactly the opposite ended up being true, driving up the cost of used cars, and then leading them to skyrocket here leading into March. But what's insane is, take a look at this, folks. First, we had a lot of economists talking about the Manheim Index and about, look, it's inflecting down. Maybe it'll stabilize a little higher here at the shelf, but eventually it'll just keep trickling down. But folks, look at what it's doing again. Once again, it's inflecting up. The same thing is happening with wages. We're seeing wages go up. And yeah, we hope that productivity goes up to offset this. But folks, the things that we're expecting to be transitory are lasting a lot longer. This creates issues. Look, for example, at oil. Cathie Wood, for example, was cheering the fact that much like her expectations for lumber, oil prices would come crashing down. Well, unfortunately, that has not happened. Oil prices have not come crashing down. In fact, if we look at a chart of Brent crude, just to see what the pricing is of Brent crude, we'll see we haven't been at these highs for years. Take a look at the view for Brent crude. We'll go out to the max view over here on the right. And we're going to take this Brent crude chart all the way to 2017, where we could see that we hit a peak of $83.91 here briefly in October of 2018, came crashing down. At one point, oil was trading negatively during the recession, and we are straight back up to these high 2018 levels, which is interesting because in the fall of 2018 is also where the Federal Reserve was talking a lot about raising rates. to rein in inflation. And this always creates the debate of, wait a minute, do we blame the chicken or the egg here? What came first, inflation and then oil prices going up, or oil prices going up and then that leading to there being inflation because oil is measured in the CPI? Who knows? But the point is, you got used cars inflecting up. You've got lumber slowly inflecting up again. You've got oil prices inflecting up, natural gas up, food up, a lot of inflationary issues pushing up. Cathie Wood obviously takes the reverse argument and says, but we're in longer run cyclical trends of deflation. And I'm going to talk about my thoughts on this in just a moment, but I want to pay a little bit of homage to oil, which is something that I've not paid a lot of attention to because I'm not a commodities trader. And so I wanted to find out, why is it that oil prices are doing this? Are oil prices going to potentially be temporary, right? I expect that once we get our supply shortage dealt with, that the used car crisis will abate and prices will come down. But I want to know, are we in it with longer or higher oil prices for longer? And this is very important because it would keep inflation higher for longer. And so The Economist did a piece and indicated that there are 3 reasons we have higher oil prices. One has to do with the start-stop uneven recovery that we've been part of. For example, China was killing it. Now it's slowing down coming out of the recession. And this is the COVID recession. America is going full steam ahead, and Europe is trying to catch up to America, but it's doing so slower, while poorer countries have yet to pick up at all. COVID factory shutdowns hurt a lot, like Taiwan shutting down factories, losing Nike about 10 days worth of production. Note, it is worthy to mention that 50% of Nike's footwear is produced in Taiwan. Freight futures have obviously skyrocketed, as we've got almost 80 vessels docked outside of the port of Los Angeles, when usually on an average day we have 1. We now have 80. Copper has skyrocketed, partially because of mine closures in South America, thanks again due to COVID, right? So it's this constant COVID pressure, right? We're seeing this over and over and over again. But this sort of start of our economy affects oil, because oil producers can't just turn the valve on or off or on or off or on or off. It's frustrating. So if they just keep production steady but lower, then if prices go up, great. It just means more profits. Now, usually what happens then is someone around the world just ends up turning on the tap to produce more oil. American fracking companies frack more, or OPEC produces more oil, but everybody together is refusing to do that. They're not doing that, and there's potentially a reason for that. We'll talk about that in just a moment. But another factor that's affecting oil prices is the fact that you have governments pushing this green transition, villainizing oil, and really favoring natural gas as a transition fuel. Now, this is not a video to talk about how we should transition or should not transition from oil to green energy. I think the green energy has a long way to go before we can actually transition. And quite frankly, I get frustrated when I hear people on the green side make arguments like, we should be 100% green today. Great, but we don't have the chips. We don't have the technology yet. I can get behind batteries and windmills and solar all day long if they support and sustain our grids. But as long as California keeps having power outages because California refuses to invest more in improving our natural gas efficiency, while at the same time we're shutting down a nuclear power plant that supplies 9% of California's electricity, don't talk to me about not wanting oil and natural gas, because we need it to survive as humans. Okay? So again, I'm a big bull on EV, but it's gonna take way longer than we expect. And politicians just like to be all, we're going green, we're going to punish natural gas and oil. It doesn't do anything when we can't get to the energy sustainability that we need yet. I'm all for, I want to make this clear, more investments. This is why lithium, for example, is up 21%. But in part, natural gas is skyrocketing because of this green transition push away from oil into green, but we're not ready for that green transition yet. So you're also seeing oil go up on top of that. But look, it's not just the stop and go of the economy, especially with COVID shutdowns and things like that. And it's also not just politicians pushing green. It's also the fact that we've got a lot of crazy geopolitical tensions going on in the trade world, which creates uncertainty. Remember, uncertainty generally leads to pain in pricing, and in oil, pain in pricing tends to mean pricing of oil goes up. Like, it's one of those things that goes up with uncertainty because it's a commodity that we use regularly. When we have certainty that there's plenty of it, then prices come down. When we're uncertain about the future of oil, like are we going to have enough, prices go up. And so here are just some examples that are helping mess things up. Russia is purposefully limiting the sale of gas to Europe, allegedly to help them get their desired pipeline through. China and Australia usually have a good relationship, but now China has embargoed Australia on their mining and farming exports, increasing prices for materials and food, leading to inflation in prices for things like iron ore, coal briquettes, and aluminum oxide. We've seen aluminum skyrocket. Europe's natural gas costs are up 80% since literally August, which is a month and a half ago. Now, iron has fallen about 40%, but that's partially because China is reducing steel demand. But now coal is skyrocketing because Mongolia is in a COVID lockdown. So it's like, even if lumber or iron falls, coal or other things just take their place in this sort of inflationary argument. But these sorts of commodity uncertainties also lead to pain in oil for people who consume oil, which means higher prices, which is actually good for people who produce oil. Now, oil is also over $80 because OPEC and its allies are being pretty disciplined in not raising more. Usually you have somebody who goes rogue and just starts producing more because they want to profit more. OPEC is the Organization of Petroleum Exporting Countries. It is a group of 13 of the world's major oil exporting nations. OPEC wants to manage the supply of oil. It's kind of like a cartel. It's kind of like they collude to set the price of oil so they can all establish production and not go through these crazy stop and go waves of production on, production off. That's really bad for oil rigs. It's hiring engineers and it's firing people or laying them off. It's a mess. It's a disaster. So because there's so much uncertainty in economics and the commodities market right now, just giving you some of the other examples that I have, a lot of folks in OPEC nations are saying, let's just keep production on a slow growth trajectory. And if the price of oil goes up, so be it. We'll make more. And again, usually somebody breaks the rules and just produces more oil. But right now, everybody's being pretty much in agreement on this. Nobody wants to go through this stop and go. So countries are agreeing with this. This also follows the fact that we got an announcement that OPEC Plus, which includes some countries like Russia, are purposefully increasing oil production by about 400,000 barrels each day for about a month. But they're going to do so gradually. And quite frankly, this current rate or this newly announced rate is nowhere near enough to meet the demands that the world has for oil right now, especially as things start reopening. See, Delta going away actually helps boost potential inflation concerns, especially in oil again. Now, the United States can try to negotiate. It can do a lot. Saudi Arabia is one of our biggest allies, big member of OPEC. But the reality is, America itself isn't drilling more. And this is another big issue. Remember how earlier I mentioned that, hey, our oil producers are purposefully not producing more because of that stop and go cycle? What they're doing instead of drilling more is they're paying off debt. They're actually deleveraging and instead returning money to shareholders. And this is why we're seeing energy stocks up about 40%. They're doing stock buybacks. They're raising dividends. Folks, we have just 528 operating rigs in the United States right now. That is half of what we had in 2019. At the same time, you've got Biden talking about maybe cutting his push on biofuels to prioritize other issues. And you've got HSBC forecasting that we could see pain in oil until 2025. Folks, this is nuts. Some of these inflationary factors are just going to be more persistent. We hope that the supply chain issues wane. And this video wasn't much about the supply chain issues, though we did talk about the Manheim Used Vehicle Index. This video is mostly about commodities. Unfortunately, commodities make up a big part of inflation. And so we might continue to see inflation from the energy side. Now, when we look at inflation, we generally look at headline inflation, and then we look at inflation like CPI, less energy. We do that on purpose so we could try to extract the crazy volatile fluctuations that we get in energy. But lately, inflation and commodities have kind of been moving in sync. And that's because at the same time as we're having these issues in commodities, we're seeing rents increase, in some cases 10 to 15% year over year. We're finally seeing rents move up at a higher pace. We're seeing those used car vehicle prices go back up. That's going to hurt. We were expecting used car vehicle prices to go down to offset rents, but now we're seeing both of these go up. And we're seeing wages go up, plus energy go up, plus food go up, the inflation crisis persists. And so even though I've been very hopeful for September and October readings of inflation to come in lower than expected, we might be in a situation where we actually end up having higher expectations for inflation. Right now, we're expecting to see inflation come in at a headline reading of 5.2%. This data comes out next Wednesday. It's the CPI release. It's possible we're going to beat this again. Month over month inflation expected to come in at 0.4%. We might beat these numbers. And here's what that means for our investments. If inflation comes in hot again, the typical trade is crypto rotates up and tech stocks rotate down. That is the typical rotation. That is what I would expect. However, that is not changing, ironically, my investment thesis. My investment thesis is stick with the Teflon, tech, and innovative growth companies. The Enphase, the Etsy, the Tesla, the companies that benefit from the innovations and transitions of our world. Because in my opinion, even if this inflation crisis lasts longer than expected, all it's going to mean is I'm going to have more of a longer term buy the dip opportunity in my favorite investment opportunities. Again, like Enphase, Tesla, Palantir, you name it, my innovative growth companies. Yeah, these have higher earnings multiples, but that's because they've got innovation and growth. They're not making cheap, lame, frozen food and sitting on an aisle somewhere and having to convince their customers to come back every single month just to try to meet earnings. These are companies that have recurring revenue. These are companies that have real and actual growth and solve real problems that we have in our society, not pump people full of cheap, salty foods. And so, without being salty about inflation, I want to make it clear. I'm staying the course. I'm going to keep loading up on what I believe in. I'm probably not going to sell my Bitcoin again. Now, for some of you who didn't hear that, I did sell my Bitcoin just to lower my cost basis, which I successfully did thanks to the Evergrande news. I sold my Bitcoin at about 44.8, and I rebought most of my crypto while Bitcoin was sitting around 41.9. So I got a little bit of an adjustment to the downside there. Probably wasn't worth the risk. It worked out, but I also like trading. I enjoy the challenge. That worked out great. But I probably will keep my crypto and continue investing in real estate as my two hedges for my innovative stock portfolio. Now, I've got a big position of my stocks in Tesla, Enphase, right? Some of these high growth companies. And some of them are part of the green energy. In fact, both of these are part of the green energy transition, which is great. But they're going to suffer potentially from the chip shortage and other issues for the near term. Near term could be the next 6 months. It could also be the next 12 months. So we'll see if their growth ends up being capped because of some of these inflation headwinds. Potentially, we're going to see Treasury yields rise. But so far, Treasury yields have been stable, which somewhat indicates that bond markets expect inflation to stay high longer, and as a result, the 10-year Treasury is staying stable, but we're not actually expecting an inflection point to the upside. So again, we'll probably stay in the same sort of windy situation where we are, where inflation just remains high. You have the consistent headwinds against technology stocks, which creates buy the dip opportunities. You have some backwinds for crypto, which is good, not super strong, but maybe helps us stay above 50,000 on Bitcoin. And overall, I think the investment thesis stays solid. The longer of an opportunity we have to buy the dip, the longer of an opportunity we have to go make money and then invest it. So folks, these are my thoughts on what is happening with the inflation crisis. No matter what happens, I am staying the course with my thesis, and I see opportunities of inflation actually helping me get discounts on the companies that I want, because even if this inflation does last much longer than expected, 6 to 12 months longer, or maybe even 18 months longer or 2 years longer, I'm game. I'm in it for the long run. I'm in it to win it. But I'm going to stay away from call options on these particular companies that I'm making those long investments in. I'll go for shares or sell puts, and then if I get assigned shares, great. If I can farm the credit, that's also great. Folks, thanks so much for watching this video. If you want more insight, check out the programs linked down below in Building Your Wealth. And folks, we'll see you in the next one. Thanks so much. Bye.